Hey, what's up, guys? It's Jonathan here. So, I want to start off this live stream on a little bit of a light note, with this picture of J-Pal that I found while I was prepping for the video. I don't know, I thought it was pretty hilarious. This was back in the good old money printing days. So, he's holding a little Bible here saying, F your puts, money printer goes burr, bears BTFO, recession canceled, and stocks only go up. Man, those were the good old days back before he decided to destroy the economy, but hey, whatever. So, we got a couple things to talk about today. So, mostly what I wanted to talk about was mostly inflation related. So, I guess let's just get right into it. So, the first thing we want to talk about was oil prices. So, throughout, so let me get this started properly. Hey, what's up, guys? It's Jonathan here. So, throughout 2020, there's been a pretty aggressive increase in gas prices, most initially fueled by the Russian-Ukraine war that started in March, and it was exacerbated by inflation and the overall demand for travel. But over the past couple of weeks, we started to see a divergence between oil prices and oil company stock prices. So let's talk about it. So right now, the USO, which is United States Oil, it's the ETF that tracks oil prices, is currently down 15% from mid-July. Whereas at the Whereas at the same time, oil stocks themselves are up 32% in the same time frame, which is really weird. You would think that, okay, if oil prices are coming down, oil stocks would come down as well. Now, there's a multitude of different reasons why the market believes that this is happening. So, one of those reasons is that people just believe that the market just may need time to adjust to the lower oil prices. In my opinion, I think this is a pretty weak argument because generally speaking, the stock market is always looking forward, usually anywhere from about 3 to 6 months ahead of time. So I'm not really too sure if I buy that one. But another reason that we have too is that in the past, oil companies were caught. So in the past, more specifically in the mid 2010s, back when oil prices did spike and then crash immediately, oil companies did get caught, you could say, with their pants down, being over leveraged during that time. So they were leveraging out money. So they were borrowing money to increase production because prices were so high. But obviously, when oil prices crashed, they kind of got the poop end of the stick. So now during this oil boom that we've gone through in 2022, we're starting to see these oil companies start to play a lot more conservatively. And this is some of what's kind of getting a lot of people in the White House and American consumers overall very upset is the fact that oil companies right now are really just paying off their debt from COVID and focusing more on um sorry, give me a second here. So okay, sorry. So Um, right now, a lot of these oil companies are really focusing on paying off their debt that they struggled with during COVID, and also giving money back to shareholders in terms of dividends. And I believe even some companies are even going as far as buying back their own stock. And because of this, these are creating very strong balance sheets for these companies, which shareholders, obviously shareholders during a time of a recessionary and possibly recessionary time frame, they really want to see, they really like to see strong balance sheets. So it's another plus for their stock, and probably some of the reason why we have seen their stock perform so well recently. So Another reason why we're starting to see such strength in oil's company stocks is because prices are starting to hit a point where the future pricing is actually higher than the current spot pricing. So this allows oil companies to lock in higher prices for future production, whether whether we go through the recession that a lot of economists believe that we will go through in 2023 or not. Right now, the oil companies can lock in those prices. So that's given another bullish reason for investors to pile into these companies. Um, and and then something I should mention, I don't really think this is that big of a factor, but but recently, especially with what we've seen come out of China with the zero COVID policy, that is putting a lot of selling pressure on oil prices, but not necessarily oil stock prices, because a lot of the oil companies don't are not only multinational, but they do very little business in China anyways. So they're not really going to get affected by oil price. They're not going to get affected by oil demand in China, but oil prices will because China is a big user of oil throughout the world. So this is a little bit more of like a long-term catalyst in my opinion, but it is something that I think I should mention because I'm pretty sure I'll hear about it in the comment section if I didn't. So, what are my thoughts about oil? So, oil prices I don't think oil prices are sustainable at these levels. I still think that there is some room for oil prices to soften. Um, Especially if we do end up going through a recession, as many people predict that we will. I think that oil demand will definitely slow. I think travel demand will slow down, and travel demand will slow down oil demand as well. And I think it'll cause a lot of Americans to really reconsider what they're spending their money on. So I think that will be a demand destruction kind of event. When it comes to but I think that the big catalyst that we have to really watch out for is the end of the Russia-Ukraine war. Not until we see the ending of that conflict, we really won't see a massive downfall in oil prices. And I think we will still see a lot of the volatility that we have seen ever since that war started. So that's my opinion when it comes to oil prices. Now, when it comes to oil companies like oil stocks, like Chevron, Exxon, blah 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 blah, this one's a little bit more tricky because on one hand you can't say, oh well, those companies are richly valued because of the price of oil, and they've been making hand over fist money because oil is so high. But the problem you have to consider is that a lot of these companies as well also invest in renewable energies as well. So they invest in charging stations, natural gas refueling stations, and stuff like that. So it's kind of hard to say, oh yeah, they're not going to do well in the long term. And to some degree, I kind of agree with that. I think that there are better players for alternative energies than some of these oil companies, but that's more of a long term perspective. In the short term, so anywhere from now to like maybe 2 to 3 years out, I think oil companies can still do well, especially given the fact that they are able to lock in such high future pricing right now. So it's one of those things where I think oil companies will suffer at some point, but I don't think I would personally go out and short oil or start buying puts on oil. And the reason why is when because it's I feel like it's going to take so long for that to play out, that um, destruction of the valuation of oil companies, that you that it'll how do I explain this? So when you short or you buy puts on a certain security, what ends up happening is that usually you have to pay some kind of premium for doing so. So when it comes to shorting a stock, you usually have to pay some kind of interest because you are technically borrowing that stock from someone. And when you buy puts, you have to pay for um, data decay that's happening with those puts. So, and then when it comes to selling calls, in my opinion, that doesn't really make sense unless if you're already bullish on the position overall. So, because of that, I really wouldn't short oil. But I don't think that their dominance is going to continue much longer. So, thank you guys so much for watching, and I'll see you in the next video. Peace. Okay, so that's the first thing I wanted to talk about. Um, so kind of staying on the topic of inflation, I do also want to discuss the difference between talk about the prices with new and used cars and the deflection we have seen there recently. So let's get this started properly. Me- Okay, so hey, what's up, guys? It's Jonathan here. Ever since the reopening back in March of 2021, we've seen used car prices rise by 34%. And in that same time frame, we've seen the price of new cars rise by 19%. But in recent months, we have noticed a divergence between the price growth of both new and used cars, which is very telling not only to inflation, but the overall trajectory of consumers and the economy. So let's talk about it. So back when we looked at the CPI report for October earlier this month, we noticed that new cars had risen by 0.4% month over month, whereas used cars actually fell in price by 2.4% month over month. And with the car section making up about 8.5% of CPI combined and 11% of core CPI, which is CPI minus food and electricity, food and energy. Most of the past 2 years, prices have for most of the past 2 years, we've seen these prices move in the same direction. So so we are starting to see kind of a divergence between the way the price movement of the two are going. So when it comes to used cars, back in 2021, we did have low inventory due to the high supply of um, we had low inventory due to the high demand of used vehicles. And this was mostly because, once everything reopened, people started going back to work. Demand for travel increased. A lot of people had a lot of savings, so they wanted to upgrade their vehicles. And there's a whole multitude of reasons why we saw such a high demand for used cars, and just really cars in general. But ever since car prices reached this peak in used cars Ever since used car prices reached this peak in January of 2022, it has fallen about 16% to today. And this shows that we are starting to see some demand destruction from working and class households with less money to spend on cars, because these are usually the demographics that will spend money on used cars. This could be due to a multitude of different things, but really two main things is inflation that's requiring them to spend bigger chunks of their income on other necessities like food, energy, and so forth. And then the lack of credit options as well. Currently, right now, the average rate for used cars is about 12%, which is much higher than what we saw back during the lows of 2020 and 2021. So, um, and obviously, this is because of the actions of the Federal Reserve hiking interest rate and tightening monetary policy. And a lot of what we've seen has reflected in used car dealers as well. Currently, CarMax is down about 50% for the year, whereas Shift, which is a competitor to like Carvana, is down about 92%, and Carvana itself is down 97%. And the a car shortage doesn't really help these kind of companies because they make a lot of their money based on the amount of volume of used cars they sell. So this is no surprise that we are seeing these companies suffer. And also, I mean, to be fair as well, some of these companies are just very poorly managed as well. So when it comes to new cars, obviously what we're seeing, obviously we're seeing the opposite. We're seeing the growth of new car prices continue to increase. Um, and this shows us that wealthier households are opting to buy more expensive and nicer, newer cars. According to auto conglomerate Cox Automotive, for the past 18 months, almost all cars have been either pre-sold or sold within 7 days of delivery. So we are still seeing very strong demand for new cars. The price of new cars is still moving up month over month, and it hasn't really slowed down the way used cars are. So, so what can we take away from this? So, the number one takeaway we could get from this is that this becomes a little problematic for the Federal Reserve, mostly because it makes the picture for them a lot cloudier. You know, cars have been one of the biggest drivers of inflation ever since we've kind of noticed this has become an issue in 2021. And now, because we're seeing used cars start to lose value, but we're seeing new cars gain value, it's making things very blurry, and it may cause the Fed to accidentally over tighten. And I mean, even even other economists are seeing this as well. JP Morgan believes that used car prices will fall 20% in 2023, whereas new cars will only fall 5% in 2023. So it will be important for the Fed to be able to decipher what's going on here and really be able to tell, okay, well, the used cars are demand destruction is getting destroyed, but new cars aren't, which means that wealthier people still have a lot of money to spend. That brings me to another conclusion that we could pull from this, and I think this is a little bit more important, is that it shows that there's divergence. There's a divergence, the same divergence that we saw with household debt, whereas poorer households are are straddled with more debt as a percentage of income compared to wealthier households in comparison to pre-COVID to now, which shows that again wealthier families have more purchasing power and less wealthier families are starting to lose their purchasing power. Um, So, and this made me think, okay, we need to start looking more at companies that actually that actually cater to more wealthier families and companies that have more pricing power. So, a good example of this would be a company like Tesla, because the average Tesla driver, um, the average Tesla driver, I believe, makes about 140K a year. So definitely in the range of higher income. So this may be something you may want to consider with your investments for the next year or so, especially if we do get that recession that we have all been hearing about. So for me, when it comes to for me, in my opinion, when it comes to buying a car, I don't think right now is the best time to do so. I think it would be much more beneficial if you were to weigh it out. I think it would be much more beneficial if you were to weigh it out. And this isn't financial advice. This is just kind of my opinion. If you're to weigh it out another about 3 to 6 months, and where I think that the price for used cars will finally start to collapse. What we do hear from the automobile marketplace is that there's a lot of inventory that's being held back when it comes to the used car space. So I do expect to see more softness with used car prices. And honestly, in my opinion, I think almost everyone should be buying a used car. I don't really see the point of you buying a new car. Even if you buy a used car that's like a year old, like it's still better than buying a new one in terms of finances. But anyways, that is all I got for you guys today. Thank you so much for watching, and I'll see you in the next video. Peace. All right, so um, doesn't seem like we have any comments, so I think I'm gonna end the stream. Thank you guys so much for watching. I'll see you next stream. Peace.